highs this year, and that momentum is expected to continue. Retail investors projected to fuel a $500 billion stock buying spree through the end of the year. That's according to JP Morgan analysts. Joining me now, Shana Orczyk, Sissel, Banríon Capital Management CEO. Shana, it's good to see you. So we have seen this activity happening in the market here. I know you in particular zero in on alternatives, and you offer advice on that realm, if you will. But first, let's linger on public equities for a moment and kind of the trends that we have been seeing there. So much attention, obviously, on the part of retail investors is on the public markets.
Yeah, I mean, you were just pointing to it. One of the trends we've seen recently is that the buy the dip phenomenon. It's the retail investor who has been more right through this cycle, the willingness to buy the dip, the willingness to go in when markets are down and having that bullish mindset. Versus in the past, in history, it had been the institutional buyer. And we've seen kind of a flip where the retail investor has been outperforming largely the institutional investor. And I think that's an interesting trend. We started to see, through the pandemic that the retail investor was more willing to take risk, and risk assets have benefited from that.
Yeah, they've been outperforming basically by just continuing to buy stocks, right? And so it doesn't seem like, to the point of the data we were citing, that there will be any kind of fundamental shift in that strategy necessarily, because the buying has seemed to happen even when the sort of macro tides would seem to be against that, against that logic.
Yeah, so I come from the generation that came into the market right around the tech bubble bursting. So my generation, which is largely the folks in the institutional space, we're a little gun shy. We tend to always expect a downturn in the market because for the vast majority of our early career, it was one thing after another. I think we're coming into a generation, for better or worse, that the market just kept going up. You figure coming out of the financial crisis, 2009, so we're 16 years in. Feels crazy saying that, but 16 years in, and the market has largely gone straight up. We've had a couple of hiccups, but they've been short-lived, and we've seen an immediate move back upwards. And I think now we have a generation that's been their experience, and so they're more inclined to jump in. And if you look back at investor sentiment over time, whether we talk about the folks coming out of the Great Depression, the baby boomers, or the like, they tend to behave, if you talk about behavioral finance, based on how they grew up in the markets. And now we have a generation that grew up in a market going straight up. Again, this could be for better or worse, but I think that's really what drives them and their willingness to jump in and buy the dip, as we like to say.
And Shana, again, you look sort of at the alternative space. Do you think that private markets, crypto maybe less so, do you think it's going to be a tougher sell to a retail investor that has done so well in the equity market? Will that diversification argument play as well for them?
So let me go on and kind of say this. I strongly believe, even though obviously my entire business is based on the idea that more alternative investments should be in people's portfolios, but I'm also very clear that not every alternative investment is meant for every investor. And so let's just start there. I think there are plenty of surveys out there that you can find that continue to support the idea that the vast majority of retail investors under the age of, say, 50 are completely comfortable and actually want alternative investments in their portfolio. And I would throw crypto in the alternative investment mix. The much younger generation, obviously, is a huge appetite for the crypto assets. But I would say that the vast majority are looking to have that. The democratization of alternatives, the huge trend in the industry right now is every single major Wall Street organization is looking for a way to monetize alternative investments. How do they get their piece of the pie? Because the demand is there. The problem is less about whether or not there's demand and more so about how do you actually implement it. We can argue about or debate, some of the recent changes that I've seen that I don't actually think are for the best interest of investors. But ultimately, it's coming from the fact that the demand is there. And so these investors do want these investments. Absolutely.
Let's bring in Tom Sosnoff now to the conversation, Tasty Live founder and CEO. Hey, Tom, we were talking about public markets. Now we're talking about alternatives. I'm going to circle back to public in a minute, but I do want to get your take on alternatives and these new rules about what could go into 401ks. What do you think that investors need to know here? And do you think that there is a risk because of the fee structure of things like private equity in particular that maybe retail investors need to know more about?
Listen, there's always a risk when you change up kind of, what traditional or legacy finance has always done with 401ks. But the reality is we have been advocating for probably 25 years now to open up, 401ks. And basically, we started with IRA accounts. We've done a really good job of opening those up to stock options, futures, derivatives, complex strategies, all that kind of stuff. It's about time for 401ks to let people make their own decisions. Of course, there's going to be more risk. And of course, it's going to introduce, new products and new types of risk and new know-how requirements and all that kind of stuff. But the reality is it's good for financial literacy. It's good for the business. And the traditional way of doing things, that was kind of closed anyway. You really didn't know what you were buying or selling when it came to just selecting a fund. You really didn't know what the fees were, and you really didn't know what the performance was like. So I actually think this is a really good step, and it's long overdue.
And so, Tom, I do want to circle back around to the public market part of the discussion here.
Sure.
And you and I have talked about this before with regard to meme stocks, but even more broadly within the stock market right now, the role that retail investors are playing. Does it provide a floor under the market, a higher floor that maybe didn't exist in the past?
Well, clearly, the market needs retail investors. They really balance out a lot of the institutional fluff. And we've argued for a long time that retail investors actually might have a better grip on markets than professionals because they're less about the last quarter is essentially make or break for me. So I think that the retail investors, I'm not sure that they provide a floor, but I think they provide some, they commoditize markets a little bit and they make them a lot more sensible. They're more reasonable because retail investors are involved.
Do you think the retail investors, Shana and I were talking about how sort of the younger generation of investors, yes, they lived through COVID, of course, but that was
Sure.
Unusual. They haven't yet been investing during a longer period, a longer bear market, right? And so does that make them much more risk tolerant than their predecessors?
Well, the challenge for younger investors is that, just like you guys were discussing before I came on, since 2008, 2009, outside of an isolated, very short-term, quick sell-off like 2018 or 2020 or 2022 for a relatively short period of time, or even, last August or this April, all those sell-offs have been very short-lived. And so if you've bought every dip since 2009, you really haven't experienced any kind of a long-term, bear market. So in most people's eyes, and when you look at all the different asset classes out there today, there's virtually no asset class that suffered any kind of a long-term sell-off. So you're right. People haven't experienced some of the things that we experienced in the 70s and in the 80s, and early 90s and things like that. And so, yeah, I think their perspective is a little bit different, but you know what? I don't think that matters. I think you just, it's always been a marketplace. The listed marketplace has always been a place where you have to trade what's in front of you. And you can't really think about what happened, 35 years ago or what happened, even 14 years ago.
Right. And so lastly, I guess I want to ask you guys each a vibes question from the perspective of the audiences that you are interacting with. Shana, you're talking to wealth managers, RIAs, et cetera, who are your clients. What are their clients' vibes right now? We've got all these sort of macro headwinds. People are still putting money in the market. What's the read you're getting from them?
So the read I get from our clients, like you said, which are the advisors, the wealth managers that work with the retail investors, is obviously there's a lot of demand for these alternative investments. There's a lot of demand for risk, risk assets, crypto, and the like, especially of the younger generations. I think the vibe from that audience, though, that we serve is a little bit of tentativeness. They are really concerned about risk, and we can circle that back to the 401k discussion. I think ultimately the issue here with plan sponsors is going to be the risk aspect of it. And so we spend a lot of time doing a lot of education, because while the demand's there, we haven't seen the flows. And the reason we haven't seen the flows is largely because the product is, kind of fragmented and where it fits, and finding it can be hard. Our industry does no service to that investor by poorly categorizing these things. But really, it's about understanding the risks associated, and nobody wants to, with the regulatory pressures and all kinds of guidance from the Department of Labor and the like, putting pressure on fees. You really need to be able to justify your fees, and advisors want to make sure that they keep the clients. And that's their number one concern. So for us, the vibe is, okay, I'm open to this idea, but help me get my arms around the risk so that I don't lose my client.
Yeah, makes sense. And then, Tom, same question to you for the audience that you guys are serving, who are people who are more directly involved in the market.
Yeah, because we serve, the self-directed retail investor.
Right.
But what we're seeing on the sidelines is, and I think, I think this is one of the reasons the market just continues to go higher. And also one of the reasons you've seen some of these crazy moves in IPOs is there is an appetite right now for speculative risk. We call it like an appetite for asymmetric risk. And people, it's indicative of a fairly, let's say, frothy market. It's indicative of a market that may be rich relative, but there's still this incredible demand. And I think, anytime you get to this kind of, it's also a certain level of capitulation, I guess, to a certain extent. That's what creates that frothiness. But there's demand for speculation, and there's demand for a lot of upside speculation. That's why you see these crazy moves in digital assets. You see these moves in IPOs, and you also see these moves in some of these tech stocks. And I think that until everything reverses and they scare the children a little bit, probably more of the same until they flip the cards.
We'll see if and when that happens. I guess it always does. Shana, Tom, thank you so much. Good to see you both.
Thank you.
Thanks so much.
Thanks. Coming up, some trending tickers that we're watching, plus how to play